Many people work every day with great effort to earn money. They follow schedules, complete tasks, solve problems, and receive a salary in return. However, very few people truly understand a financial tool that has helped millions of people around the world grow their money over time: stocks. Stocks are part of the world of investing and represent one of the most well-known ways to participate in the economy of businesses. This is not magic, and it is not something reserved only for experts. With clear information, patience, and discipline, anyone can learn how stocks work. The goal of this text is simple: to explain in a clear and easy way what stocks are, how they work, and how they can help improve a person's financial life. What is a stock? A stock is a small piece of a company. When a company needs money to grow, expand, hire more employees, create new products, or open new locations, it may decide to sell part of itself to the public. That ownership is divided into small units called shares or stocks. When someone buys a stock, they become a partial owner of that company. This means several things. They have the right to share in part of the company's profits. They can benefit if the company grows and increases in value. In some cases, they can vote on important company decisions. For example, imagine a company worth $1 million that decides to divide itself into 1 million shares. Each share would represent a very small portion of that company. If someone buys 100 shares, they own a small part of that business. Why do companies sell stocks? Companies sell stocks mainly for one reason: to raise money to grow. Creating products, expanding into new markets, building factories, or investing in technology requires large amounts of capital. Instead of borrowing too much money or relying entirely on loans, a company can choose to offer shares to the public. When this happens, many people can buy those shares and become investors. The money investors provide helps the company continue growing. If the company succeeds, both the business and the investors can benefit. How people make money with stocks. There are mainly two ways to make money with stocks. 1. Increase in stock price. If a company grows, sells more products, earns more revenue, innovates, and becomes more valuable, many people will want to buy its shares. When demand for a stock increases, its price may rise. If someone buys shares at a lower price and later sells them when the price is higher, they earn a profit. Simple example. A person buys a share for $10. Later, the share is worth $25. If they sell it, they make a profit of $15 per share. 2. Dividends. Some companies share part of their profits with shareholders. This payment is called a dividend. Dividends may be paid every 3 months, every 6 months, or once per year. This means a person can receive money simply for being a shareholder. How the stock market works. Stocks are bought and sold in places called stock exchanges. Stock exchanges are markets where thousands of people buy and sell shares every day. The price of a stock changes constantly. This happens because the price depends on something very important: supply and demand. If many people want to buy a stock, the price goes up. If many people want to sell it, the price goes down. What makes a stock go up or down? The price of a stock can change for many reasons. Some of them include: company growth. If the company sells more products, earns more money, or expands its operations, investors may feel optimistic. News. Positive news can push the price higher. Negative news can cause the price to fall. The economy. When a country's economy is growing, many stocks may rise. When economic crises occur, many stocks may decline. Expectations about the future. Investors do not only look at the present. They also think about the future. If they believe a company will be very successful, they may buy shares today expecting the price to increase later. Investing is not gambling. A common misunderstanding is that investing in stocks is like gambling. But in reality, they are very different. Gambling depends mostly on luck. Investing involves analyzing companies, understanding their business models, and making informed decisions. People who succeed in investing usually focus on the long term. They are not trying to get rich in a single day. They are trying to build wealth gradually. The importance of long-term thinking. One of the most important ideas in stock investing is time. Many people who succeeded in the stock market did not achieve it in days or weeks. They achieved it over years or even decades. Businesses take time to grow. Investments also take time to grow. When someone invests for many years, the accumulated growth can become very powerful. The power of compound interest. One of the most important concepts in finance is compound interest. Compound interest happens when the earnings from an investment are reinvested. This means the money begins to grow on itself. Over time, this growth can accelerate in surprising ways. Many of the largest fortunes in the world were built thanks to this principle. How to start investing in stocks. Getting started with investing is not as complicated as many people think. The process usually includes several steps. 1. Learn the basics. Before investing, it is important to understand how stocks work. Reading and learning reduces many risks. 2. Choose a financial broker. To buy stocks, people usually use a broker or investment platform. These platforms allow investors to buy and sell shares using a computer or smartphone. 3. Open an investment account. This process is usually similar to opening a bank account. Personal information and documents must be verified. 4. Deposit money. The investor deposits the amount of money they want to invest. 5. Choose stocks. After that, they can select the companies they want to invest in. 6. Place the order. Once the stocks are selected, the purchase order is completed. Something very important: invest only money you do not need in the short term. The stock market can go up and down. For this reason, it is important to invest money that you do not need immediately. Money intended for essential expenses or emergencies should not be placed in risky investments. A good practice is to first build an emergency fund. The right investor mindset. Successful investing does not depend only on money. It also depends on mindset. Some important qualities include: patience. Investments take time to grow. Discipline. Investing regularly can be more effective than trying to guess the perfect moment. Education. Continuing to learn helps people make better decisions. Emotional control. Fear and excitement can lead to impulsive decisions. The mistake of trying to get rich quickly. Many people approach the stock market hoping to become rich very quickly. This is usually a mistake. Impulsive decisions, following rumors, or investing without analysis can lead to losses. The most successful investors tend to take a much calmer approach. They look for strong companies and think about the future. Stocks as a tool for financial growth. Stocks are not a guaranteed path to wealth. However, they have proven to be a powerful tool for growing money over the long term. Many people have improved their financial situations thanks to consistent investing. The most important thing is understanding that investing is a process. A process of learning, patience, and making thoughtful decisions. Building wealth little by little. It is not necessary to start with large amounts of money. Many people begin with small investments. What matters most is consistency. Investing regularly, learning over time, and maintaining a long-term vision can produce surprising results. Many people spend a large part of their lives working to earn money. They exchange their time for income. They work hours, days, weeks, and years to cover their expenses, save a little, and try to improve their quality of life. However, there is a very important difference between working for money and making money work for you. Stocks represent one of the tools that can help make this possible. When a person invests in stocks, they are not simply saving money. They are participating in the growth of companies that produce products, services, technology, food, medicine, and thousands of things that keep the world running. Over time, if investments are made with intelligence, patience, and discipline, the invested money can grow significantly. This second part focuses on understanding how stocks can improve financial life, what strategies exist, what mistakes to avoid, and what precautions to take. Changing your mindset about money. One of the first steps toward improving financial life has nothing to do with numbers, but with mindset. Many people grow up hearing ideas such as, investing is only for rich people. The stock market is too dangerous. It's better not to risk money. While it is true that investing involves risks, it is also true that not investing can be an even bigger risk. Money that remains idle loses value over time due to inflation. Inflation is the general increase in prices. Over the years, money buys fewer things. Investing can help money maintain and increase its value over time. The difference between saving and investing. Saving money is important. It allows people to create financial security and handle emergencies. But saving and investing are not exactly the same. Saving means keeping money aside. Investing means putting that money to work so it can grow. Many financially successful people use both approaches. First, they create a financial safety fund. Then they use part of their money to invest and generate growth. How stocks can change a person's financial life. Stocks can transform financial life mainly for three reasons. 1. Capital growth. When a company grows over many years, the value of its shares can increase significantly. If a person invests early and holds those shares for a long time, they may benefit from that growth. This has happened with many companies that started small and eventually became global giants. 2. Passive income. Dividends allow investors to receive regular income without selling their shares. This means the money can remain invested while still generating income. Many people use this strategy to supplement their salary or even to live from their investments. 3. Financial independence. Financial independence happens when the income generated from investments is enough to cover living expenses. It does not necessarily mean quitting work, but it means having the freedom to choose how to spend your time. For many people, this is one of the most important goals of investing. Common strategies for investing in stocks. There is no single way to invest. Different strategies exist depending on a person's goals and personality. Long-term investing. This is one of the most well-known strategies. It involves buying shares of strong companies and holding them for many years. The idea is to allow the growth of the company to be reflected in the value of the shares. Many successful investors have followed this strategy for decades. Investing in growth companies. Some companies are in expansion phases and have great growth potential. These companies can increase their value quickly if they succeed. However, they may also carry higher risk. Investing in dividend-paying companies. Some investors prefer companies that regularly distribute profits to shareholders. These investments can generate periodic income. They are popular among investors who seek stability and consistent cash flow. Diversification, a fundamental rule. One of the most important principles in investing is not putting all your money in one place. This is called diversification. Diversifying means investing in different companies, industries, or even different types of assets. That way, if one investment performs poorly, others may compensate for the loss. Diversification helps reduce risk. The importance of research before investing. Buying stocks without research is like buying a business without knowing what it does. Before investing in a company, it is important to understand what products or services it offers, how it makes money, whether it is growing or losing market share, who its competitors are, its financial situation. The more information an investor has, the better decisions they can make. The role of emotions in investing. Emotions can be one of the biggest enemies of investors. When the market rises quickly, many people feel excited and buy without analysis. When the market falls, fear may cause them to sell at the worst moment. Experienced investors try to stay calm and make decisions based on analysis rather than emotions. Common mistakes many people make. Learning from other people's mistakes can save a lot of money. Some common mistakes include trying to get rich quickly. Seeking fast profits can lead to very risky investments. Following rumors. Decisions based on rumors or unreliable advice can end badly. Investing without understanding. Buying stocks simply because they are popular can be dangerous. Selling out of fear. Temporary market declines are normal. Selling in panic can turn temporary losses into permanent ones. The importance of consistency. Many people believe they need large amounts of money to invest. In reality, what matters most is consistency. Investing small amounts regularly can produce surprising results over time. The combination of consistent investing and long-term growth can build significant wealth. Important precautions when investing. Although stocks offer opportunities, they also involve risks. That is why it is important to keep certain precautions in mind. Never invest essential money. Money needed for basic living expenses should not be invested in risky assets. Avoid borrowing money to invest. Investing with borrowed money can increase financial risk. Be patient. Investments need time to develop. Keep learning. The financial world is constantly changing. Continuous learning is a major advantage. Financial education as a tool for freedom. One of the reasons many people never invest is a lack of financial education. Understanding how money works changes the way a person makes decisions. Financial education helps people avoid costly mistakes, recognize opportunities, plan for the future, build financial stability. Building a long-term vision. The most important financial decisions are usually made with the future in mind. Investing is not just about making money. It can also be a way to prepare for retirement, support family members, fund personal projects, achieve important life goals. Stocks can be one of the tools used to build that future. Small steps can create big changes. Many financial success stories began with small decisions. People who started investing modest amounts and maintained discipline for many years. It is not about luck. It is about combining education, patience, consistency, and long-term thinking. Final reflection. Stocks represent a way to participate in the growth of companies and in the development of the economy. They are not a magic formula or a guarantee of instant wealth. However, when used with knowledge and responsibility, they can become a powerful tool for improving financial life. The first step is always learning. The second step is starting carefully. The third step is maintaining discipline over time. Many people discover that investing not only changes their finances but also changes the way they think about money, the future, and opportunities. With patience, education, and a clear strategy, stocks can become an ally in building stability and financial freedom over the years. Chart increasing.